Okay. If you remember, we started this chapter last week, and this chapter is all about refreshing your memories about financial statements. About financial statements, we're going to focus on 3 of them. Balance sheet, income statement, statement of cash flow. We covered balance sheet last time. I think we started income statement, and that's where we left off. But let's summarize what we did very quickly. Balance sheet gives you a snapshot of the company. So it gives you the cumulative number. So if you go to a company, open the vault, let's say, whatever you're going to find is the cumulative of everything, basically. And balance sheet gives you those numbers. Income statement or a statement of cash flow, it gives you the numbers only for a specific period of time. Right? So those 2 are flow statements. This is like a stock statement. What happened in the company so far. And every public company is required to announce their financial statements. In US, SEC checks them, and they generally have quarterly statements, which are 10Qs. And did you use 10Qs for your homework, for this homework at all? No, finance pages were enough? Okay. So there are lots of information about the company in those statements. And in the balance sheet, what is important is on the left-hand side, you have what the company owns, all the assets. On the right-hand side, you have the liabilities and the shares. And these are what the company owes, basically. So balance sheet should be balanced is the most important identity. So on the left-hand side, you have assets. On the right-hand side, you have debt and equity. Of course, you have book value of debt, book value of equity. And if you remember from the previous chapter, we said we are trying to increase the value of the company, value what the company owns, and future prospects as well, which translates into maximizing the right-hand side also, debt and equity part. And in the balance sheet, we said everything is written from the most liquid item to the most illiquid item. Liquid means easily converted into cash. That's why in number 1, we have cash and marketable securities. These are the items that are converted in cash very easily. Then we have account receivable, what the company owns. So the company sells stuff to the customers, but the company didn't get the money yet. But we will get the money at some point. So it's what we own. Then we have inventories. These can be raw materials or productions already produced and sitting in the garage, let's say. Then we have longer term investments. Here we have plant, property, and equipment, fixed assets. If you deduct the accumulated depreciation from those, you're going to find net fixed assets. And we're going to talk more about depreciation later. Also, we can have intangible assets. And intangible assets can be patents, copyrights, brand names, whatever. On the right-hand side, again, we have the most liquid debt, which is current liabilities. Their term is less than 1 year. They're due less than 1 year. The first items we see here is the accounts payable, and it is what the company owes. So as the company, I bought raw material from a supplier, and I haven't paid yet. So it's my debt, basically, that I have to pay. So it's accounts payable. Or you might have notes payable, which is also a kind of debt. Or any kind of debt due less than 1 year goes under current liabilities. Then we have long-term debt. In the long-term debt, you might have long bank loans, or you might have bonds, for instance. Remember, companies can also issue bonds, not just governments. Companies can also issue bonds. Then we have shareholders' equity. Again, book value of equity. What was the value of equity when it was sold to public? And it can be in the form of preferred stock or common stock. These are both equities. The difference is preferred stock gets in line ahead of the common stockholders. So first, debt holders get paid. They have the senior claim on the money that is generated in the company, then preferred stockholders, then common stockholders. So they're preferred because it's less risky, but most of the time they give up their voting rights. Okay, so this is how the balance sheet looks. Then we talk about income statement. And income statement is important because basically it tells us what is the revenue of the company, what is the cost of the company, and how much income is generated. So this is the basic form of an income statement. You start with sales or revenues, what you sold at what price. And there are any kind of costs, like real cash cost is here. You have selling, general and administrative expenses. And if you use office supplies, whatever you need, it goes under there. Then you have depreciation. We're going to talk more about this, but this is important. So this is, we have depreciation for basically accounting purposes. So when a company buys a huge item, let's say a factory, it costs what? Millions of dollars. So if you enter the cost of this factory in the income statement, in that year, it will look like you have a huge loss. And it will look really bad. But of course, since it's a capital expenditure, you're buying a factory, which is a good thing, and it will create value in the future, the accountants say, okay, let's not put that expense in the income statement. Instead, let's use depreciation. And with depreciation, every year, let's depreciate a part of this factory's value and reflect that number in the income statement. So if you bought the factory for $10 million, and if you're going to use the factory for 10 years, by straight line depreciation, you're going to enter the depreciation as $1 million each year. So you will start with $10 million, then the value of the factory will be 9, 8, 7 each year. It will go down. And it's going to go down to some salvage value. If you can sell the factory at a price, then you enter it as a salvage value. We're going to talk about those in the last chapter. But before that, you know the idea of depreciation already. You took accounting classes. But it's done to smooth things out, basically. So instead of entering $10 million that year, you're only entering $1 million as a depreciation. This will be important because we're going to talk about those in like 5 minutes in more detail. So sales minus cost minus depreciation will give you EBIT, earnings before interest and taxes. Remember, debt holders get money first, so you need to pay your interest if the company has any debt. Interest is paid. Then you end up with earnings before taxes, which is also taxable income, how much tax you're going to pay to the government. And remember, if the company has some debt, it is kind of good. Because of the interest payments, your taxable income will be reduced. So you're going to pay less tax to the government. So this is called the tax shield, the benefit of having some debt. Okay? Then you pay some tax at fixed tax amount to the government. Tax rate is fixed according to your revenue. So you find the net income. Part of the net income can be paid to shareholders as dividend payments. Remember, if you own a share, you might have dividend payments from the company. And whatever is left over in the company from net income is kept in the company as retained earnings. Retained earnings, earnings that are retained in the company. They are kept in the company. Why are companies keeping money? What do you think? So companies don't pay everything as dividend payments, keep some money in the company. Why? Very good. So it might be for different reasons. One is, let's just keep some company in cash. So if we have future investments, we are not going to deal with trying to find money from somewhere. Or they might say, okay, it's safer. Let's keep some cash in the company so debt holders will be happy. What is the disadvantage of having lots of cash in the company? So if there's a company with lots of cash, why can it be a negative signal for shareholders?
cash already, you cannot make investment and the stable money will lose value in time.
What else? I'm sorry.
Therefore, we need to use money already.
Very good. What else? But you have lots of cash. Just the opposite. Yes.
Taxes on the cashier.
Okay.
No?
No. Why? No. If you're having interest, and if you have interest earnings, then yes, you pay tax on it.
You can give dividends for shareholders.
You can,
Give dividends for shareholders.
which is a good thing.
They'll pay more taxes.
Yeah, he said the same thing. It's because you're making interest.
I mean,
Pay tax on interest payments.
no, because you don't give dividends and your retained earnings is more. So
You can pay your
But tax is here, calculated here, depending on your taxable income. Right? If you generate more if you have lots of interest earnings, let's say, then the company might be, since it's earnings, then every time you make money, you have to pay tax to the government. But actually, I was also going after what Efe said. It's basically when the company has lots of cash, shareholders would say, why are you keeping all that cash? Just make some investments. So you're going to generate more value to me. So having cash is a good thing. It's a bad thing. Okay, depending on where you are in the cycle of your life, let's say. Of course, mature companies will have more cash because they don't have much investment opportunities left. Right? They used all the resources. They went to all the different markets in the world. So for growth companies, they have less cash and they have more investment opportunities. Okay. Then I think this is the last thing we looked at. Let's focus more on the difference between profits and cash flows. And this is going to be important because we are trying to move from income statement to statement of cash flows. And income is not the same thing with profit. Oh, sorry, income is the same thing with profit. But income is not the same thing with cash. And why is it so? Let's see. One, we just talked about it actually. First of all, we said if a company buys a factory for $10 million, and let's say the company paid cash for it, then what's going to happen? Normally, there's a cash outflow of $10 million for you. But in the income statement, you don't see that $10 million, even if there's a cash outflow. Also, in the income statement, you see the depreciation for $1 million. Why? It's a 10-year factory. It's worth $10 million. So basically, for depreciation, you do 10 million over 10. You know that part, right? Straight line depreciation part. Okay. So even if this is, even if this is not a cash expense, you have it here as an expense. So as you can see, income we find is different than cash we just talked about. Just think about the factory example. You don't have the cash outflow of $10 million here, but you have a $1 million depreciation even if it wasn't a cash outflow. So because of that, we need to make some adjustments. And how are we going to make the adjustment? So basically, this is what I just said. When you look at profits or income, we are deducting the depreciation, even if it's a non-cash expense, and we are ignoring the capital expenditure, even if they are cash outflows. So every time we have the income statement, if we want to go to the cash flow statement, what should I do? Should I add back the depreciation to the income? Or should I deduct the depreciation? It's written there. Huh? No, just think. What do you think? I mean, it's written there. So. Okay, it disappeared. So I'm trying to move from income to cash. I gave you a number. This is your income. But you're interested in cash. Think about this 10 million example. What are you going to do to this 10 million?
I will aspect to depreciation expense.
You're going to add the depreciation. You're going to add this 1 million depreciation to the income. Why? It was deducted in the first place, even if it wasn't a cash expense. So you didn't pay $1 million out of your pocket, right? So you're adding it back. What are you going to do with this $10 million? Are you paying that $10 million as cash? Then you need to subtract that $10 million from profit. Does it make sense? Do I have cash? Let's just give the example. So this is $100 is the money I paid for the factory. Okay? That 10, $100 million, that 10 is the depreciation. Okay? So when I calculated, I deducted that. Now I have 55. Let's see whether we will be able to do it. I have 55. But you're going to tell me, Hocam, you didn't actually pay 10 million for the depreciation. So if we are interested in cash, you need to add it back. But this 100 million, you actually paid for the factory, so you have to just forget about it. So the profits and the cash flow relationship is important. You're adding back what you already subtracted, okay? And you have to deduct what you ignored. You ignored the cash you paid for the factory, so you have to deduct it. And the depreciation that you deducted in the first place, you're adding it back. Very simple. Any questions? Okay. So basically, every time you're trying to calculate cash from income, this is the first thing you need to do. Deduct the capital expenditure, add the depreciation, very important. We're going to see this in the statement of cash flow part again. The other thing is, this part we're going to see it a lot in the examples. So in the profits, you don't see the difference, the changes in the working capital. Do you remember what working capital was? Working capital? Exactly. Working capital is current assets minus current liabilities. What are current assets? Do you remember them? We have cash, account receivable. Do we have inventory? In the current liabilities, we have accounts payable, notes payable. So basically, every time the company is taking a project or making some production, then working capital will change. In the income statement, we don't see those changes. But actually, when we're thinking about cash flow, we need to make the necessary changes in the working capital as well. And I'm going to talk about it on examples because it will be easier to understand. And the last thing about accounting is when you talk about profit, you record the income at the time of sales, even if you didn't get the cash yet. So when you make a sale, let's say you made some sale on credit, okay? You enter it as the revenue at the time of sale, even if you didn't get the cash yet. That's why you're going to have a change in account receivable and inventory every time you make a sale. Or if you're making a sale, of course, it might be related to accounts payable. So you need to make the changes in the accounts payable part as well. So it's all about the timing of the sale and when you're going to get the money adjustment. That's it. Because we're interested in cash. I know now it's kind of vague, but I think if we go over examples, you're going to understand it better. Let's look at this example. Consider a manufacturer that spends $60 to produce goods in period 1. In period 2, it sells these goods for $100, but customers don't pay their bills until period 3. So what's happening is, you're spending $60 for the production. In period 2, you're selling the goods for $100, but you're selling everything on account receivable basically. You're not getting the money in second time 2. You're getting the money at time 3. So when you look at the income statement, it's going to be recorded when the sale is made. So you will have the revenue of 100, and then of course you have some cost related to it, and cost is basically cost of goods sold, and 60 is the cost of goods sold, and your profit will look like 40. But the cash flow for those periods will be different. So in the first period, for instance, you don't have any sales, you don't have any cost of goods sold because of that, but your inventories will change. You paid $60 for inventory, for production. Suppose that you paid it cash, okay? So because of that, your cash flow will decrease by 60, right? You spent 60 to build up inventories. It's a cash outflow. In the second period, you made the sale for $100. This is the income statement part. So you enter cost of goods sold as 60, the cost of the inventory. What happened to your inventories? Your inventories was 60, but now you sold everything in your inventory, so your inventories decreased. And what happened to your account receivable? You made the sale on credit, so your account receivable increased. You didn't get the cash, so it increased. So is there a cash outflow, inflow of that period? Nothing. Then, in the last period, you're getting the cash. How? Your account receivable decreased, right? $100 was on credit. You got the cash, and your account receivable decreased by 100. And because of that, you had $100 cash in your pocket. So as you can see, the profit is really different than the statement of cash flow, or cash flow, let's say. Another example. Okay, another example. Consider a firm that spends $1,000 to produce goods in period 1. In period 2, it sells half of these goods for $750 and collects payment 1 period later. So in the first period, you don't have any sales, but you increase your inventory by $1,000. Is there a cash outflow that period? How much? $1,000 cash outflow because you used it to produce inventory. Then in the second period, you sell half of what you have in the inventory. So you made the sale for $750. Cost of goods sold is $500. Why? It's half of 1,000. You sold half of what you had in the inventory. But did you get money for the sale? No, you're going to get the money 1 period later. So your account receivable increased by $750. And your inventories reduced by $500. You sold half of the inventory. So is there any cash in, cash out that period? Huh? Nothing. No cash inflow, no cash outflow. In the third period, there are 2 things happening. One, you're making sales. You're selling the rest of the half, remaining half, okay? Let's go there. Okay, and your inventory, you started with 1,000, you sold the half in the previous period, then you sold the remaining part in this period, so your inventory reduced by 500. What did you have in your account receivable? Huh? There are 2 things happening here. One, it's 0 here. Why? You got the cash for the sale you made in the previous period. From here, your account receivable increased by $750. Here, you're decreasing it by $750. But at the same time, now you have a new sale. And for this new sale, your account receivable increased by $750. So in the same period, your account receivable decreased by $750, money coming from the previous sale. And also from the new sale, your account receivable increased by $750. Those guys killed each other. So you ended up with 0. Okay? Is there cash in this period? How much?
70.
Wonderful. Exactly. The last one, the last period, you don't have any sales. But you need to collect your money for the sale you made in the third period. So you got that 750. You reduce your account receivable by 750. And is there a cash inflow? Yes, you got the remaining money. So that's the idea. That's the all confusing thing about net working capital was this. Make the adjustment for inventory, accounts payable, accounts receivable. That's it. And did you get the feeling for it? So what happens to your cash if your current assets increase? If your account, or let's say decrease. If your account receivable decreased, how did it reflect in your cash? Every time current assets decrease, your cash will increase. Think about inventory. What happened to your inventory when inventory increased? Cash decrease. So every time your current assets increase, your cash will decrease. Just think about account receivable and inventory example, so you're not going to get confused. Okay. For the accounts payable, think about accounts payable. If accounts payable decreases, what does it mean? You? Exactly. If accounts payable decreases, remember what accounts payable is? You bought stuff from your suppliers, but you didn't pay yet. So if accounts payable decreases, it means you paid the cash. So cash will decrease. So did you understand the relationship? So if current assets increase, cash will decrease, or vice versa. If current liabilities decrease, cash will decrease. So there's an opposite relationship, negative relationship between current asset and cash. Again, think about accounts receivable and inventory examples. Every time your current liabilities decrease, your cash will decrease. Think about accounts payable example. So you don't have to even memorize. Okay. I actually had one more example, but I couldn't open the updated version. But I'm gonna solve it in the second hour. Statement of cash flow. Statement of cash flow is just like the income statement. It's a flow statement. Okay? What it means is, again, it just tells you what happens in that particular period. It's not a cumulative statement. It just tells you what happened in that period. And this is important because by knowing cash flows, we're going to know how much cash can be distributed to all investors, to debt holders, to shareholders, to the government, how much money exists in the company. So when we talk about statement of cash flows, there are three items, three important parts. The most confusing part is cash flow from operations. But if you understood the profit cash flow relationship I just talked about, this part will be easy. Then we have cash flow from investments. Then we have cash flow from financing. So investment, financing, and daily operations, basically. It's all the cash that a company can generate. So by this, we're going to know how much cash is generated in this period. Let's look at this example, which is similar to what we covered. Net income for your firm was $10,000 last year. Income is profit, right? Net income is $10,000. The depreciation expense was $2,500. Account receivable increased by $1,250. So if your accounts receivable increased, it means you couldn't get the cash for the sale. So what's going to happen to your cash? It's almost like decreased, right? Exactly. Your accounts payable increased by $800, which means you didn't pay for the supplies, raw material you got. So it's almost like it has a positive or negative effect on cash. Positive effect on cash. Wonderful. And inventories increased by $2,000. Then your cash decreased. You spent cash to produce inventories. What was the total cash flow from operations for the period? Very easy. So you start with your net income, $10,000. Ooh, what am I going to do to the depreciation? I forgot. Should I add or subtract depreciation? You're wonderful. Exactly. You add depreciation to your income. Why? Because in the income statement, to be able to come to the net income part, you deducted depreciation, you're adding it back because it was a non-cash expense. So to the net income, you add the depreciation, you decrease account receivable. Your increased account receivable had a negative effect on cash, so you're deducting that change. For accounts payable, your accounts payable increased, which had a positive effect on cash, so you have a plus 800. For inventories increased, which has a negative effect on cash, so you decrease 2,000. So your cash flow from operations will be $10,050. Any questions on this? Anything? No? Perfect. Okay, so this is how statement of cash flow looks like. So you start with net income, you add back the depreciation, and one thing, if you have changes in your working capital, you have to do the modification. This is also something we just talked about, and this is the modification items. You have to look at what happens to accounts receivable, accounts payable, inventories, and you're gonna do the modification. Which will give you the cash flow from operations. Then we're going to find cash flow from investments and cash provided from financing. Now let's look at this change in working capital. This example is from your book. So basically what you had was this. So your accounts receivable decreased. If your accounts receivable decreases, it has a positive effect on cash. Your inventories decreased. Positive effect. Your other current assets increased, which had a negative effect. There's a negative relationship with assets. Okay. Your accounts payable decreased. You paid cash. It's a negative effect. And your other current liabilities decreased, which is a negative effect. So basically, your working capital, what is working capital? It's current assets minus current liabilities. Okay. So change in working capital from this example, it's going to be 321. So what happened here was you had a decrease in your working capital, which reflects as a cash inflow. Your decreased working capital will increase your cash flow, basically, because of this relationship. So remember, it's current assets minus current liabilities. So this has a negative relationship with cash. This has a positive relationship with cash. Ask me if it's confusing. This has a negative relationship with cash. This has a positive relationship with cash. But since you have a negative in the middle, this also has negative relationship now, right? Negative. Negative. So it's total, as a total, a change in working capital. I see you, just a second. Don't get tired, okay? So every time you have a decrease in working capital, you should have an increase in the cash flow. Why? Because overall you have a negative relationship. It's nothing new, actually. Everything we just talked about as a summary. There's confusing faces, no? You got it?
Yeah.
Is everything?
Cash apart from current assets?
Yes, but cash is cash is already the result of all those things, so you don't have to consider it anyway. So because you're right, cash is here in current assets part, but we are interested in cash, statement of cash flow anyway. So we are looking at how the changes in the other current assets or current liabilities will affect your cash. So it's already considered. Of course, if you have a chunk of cash given to you, it's going to be cash inflow. But generally, it's going to be in the financing part, you're going to see that cash anyway. From the sales, this is how things will work. When you make the sale, the cash is already reflected in sales if you got it in cash. If not, it's reflected in account receivable, so you make the adjustment. That's why. That was a very good question. So he said cash is already in the working capital. It needs to have a positive relationship. But I just told him we're looking at the result, end result of all those transactions. And also, when you make a sale, it's either if you get cash, it's already in the income statement as revenue. If not, it's in the account receivable form in the balance sheet. That's why we have to make the adjustment. So you're not forgetting anything. Okay, so you had a decrease in working capital, which reflects in a cash inflow. And once you understood all of those things, you're basically done with, you're already done with cash flow from operations. So add back the depreciation, make the modifications for working capital. Increases in current assets is a decrease in cash flow. Increase in current liabilities is an increase in cash flow. Just what I just said. And also, if you have a capital expenditure, you need to consider it. But capital expenditure will be actually here. Yes?
Turn back to the previous slide.
This
You
one?
had a cash increase at 321 here.
Yes. Yes.
Why we are here writing decrease in working capital?
So you, as a total, your working capital decreased, which is an increased cash. No, maybe I didn't get them. Okay, what's the question?
We have cash increase here, right?
Yes.
But we are writing as a decrease in working capital.
Yes. I mean, you can write it any way you want. I wrote it as decrease for you to get the details. When you have a decrease in working capital, you have a cash inflow, so this is a positive item. You can write it as change in working capital. I don't care, like normally we write it as change in working capital, but it has to be positive because you have a decrease there. As long as you know what you're doing, I don't care. Like normally you should write change in working capital, of course. But I want you to see a decrease in working capital is a cash inflow. That's why I wrote it this way. Are you confused? What happened?
Maybe we can evaluate.
No. No break. We started very late because of the technical problems. Bunu deyince de insan şey olmuyor. Okay. Let me just finish statement of cash flow at least. Then we're gonna take a break. Just like two, 3 more slides. You can survive, I'm sure. Okay, this part is very easy. Seriously, very easy. The last part is also very easy. So cash flow from investment, very easy. If you buy something, it's cash outflow. If you sell something, it is cash inflow. Very easy. So basically it says, cash provided by disposal of PPE. What is PPE? Plant property equipment. What is disposal? You got rid of them. If you sell, wait a minute. I think there's a thing. Okay, so if you sell something, it's gonna be cash inflow. Here, this is actually, it is cash used to buy PPE. If you use cash to buy plant, property, and equipment, it's going to be a cash outflow. I was just confused about this. But since it's a cash outflow, it means you bought something. Okay, then it's the easiest thing. If you buy something, cash outflow. If you sell something, cash inflow. That's it. Same with this. Sales of other investments. You made some sales, so you had cash inflow. So in this picture, the company bought PPE, cash outflow, made other investments, sale other investment, cash inflow. Overall, you have a cash outflow. So let's go back to the balance sheet and try to find this number. 1122. We bought some PPE. Let's go back to our balance sheet. 1122. Don't forget that number. Okay. If we are able to go back to balance sheet, here, yes. So what is the PPE? Here, in the balance sheet, you have PPE as 37,345 for 2009. Where is this 1122? Huh?
Already in.
It is already in. If you take the difference between these two numbers, this is the PPE at the end of 2008. This is the PPE at the end of 2009. So if you take the difference between these two numbers, it will tell you how much PPE is bought, which is 1122, which was in the income statement. This is a snapshot. It gives you the cumulative numbers. Statement of cash flow gives you what happened in that particular year only. So they're all related, basically. So this is the cash flow from investments. The last part is cash flow from financing. Bana dur deyin. In the cash flow from financing, if you pay your debt, it is cash outflow. If you found some debt or if you issued stock, it's cash inflow. So here it says you paid your short-term debt. It's a cash outflow. You paid some of your long-term debt, cash outflow. You paid dividends. Dividends are here. Cash statement of cash flow. If you pay dividends, it's of course cash outflow. Then this company issued some stock. When you issue stock, you raise money. You got money from the public, so it's a cash inflow. There are other stuff as well. So overall, there's a cash outflow of $3 billion for this company. So now you know the cash flow from operations, which was the net income, depreciation, working capital part. You know the cash flow from investments. 2 more slides, don't go. And then you have cash provided by financing. One question. The money you paid for the factory, where should we see it? The money for the depreciation, you made the adjustment in the cash flow from operations part. In working capital part, you would make the adjustment in the cash flow from operations part. How about the factory, the money we spent for the factory? Wonderful. Cash flow from investments. There will be a cash outflow of $100 million for the factory. Last 2 slides. One easy question. Which of the following activities increase the firm's cash balance? Increase cash balance. Increase in inventory. Nope, you paid money. Decrease in accounts payable. Nope, you paid money to your suppliers. Issuance of additional common stock. You issued stock. You sell stock. Yes. Cash will increase. Acquisition of new equipment. No, you paid it. Perfect. The last thing about cash flow is this. We are interested in free cash flow in the company. Free cash flow, you start with EBIT, earnings before interest and taxes. You deduct the taxes you paid for the depreciation. Since we are interested in cash, we are adding back the depreciation. You deduct you do the modification for change in working capital, the stuff we just talked about, nothing new. You deduct the capital expenditure part. Again, nothing new, what we just talked about, okay? If you do that, you're gonna find the free cash flow, which is the money available to be distributed to the government, to debt holders, to stockholders. It's free cash flow, cash that's free in the company. So I want you to find at Home Depot's free cash flow. All the examples I use is for Home Depot. You can just find it. You know all the numbers there. It will be there. And the answer is already in the notes of the slides. So the answer is there. Okay, let's take a break and then we will continue.